Hi, this is Ashish Shanker and I'm happy to present to you the first Alpha Strategist of financial year FY 1920. The theme for this Alpha Strategist is the 10-year challenge, and I'll talk more about it a little later. However, in the meanwhile, what we are witnessing globally is that most central banks have changed their stance from being slightly hawkish to becoming dovish. It started with the Fed, where the Fed was supposed to hike interest rates at least 2 to 3 times this calendar year. However, if you see the recent minutes, they've clearly indicated that they are not going to hike. In fact, what they've been messaging is that if growth slows down or if they find concern around employment, they will actually go and even start quantitative easing again. So this is a big change from last year, and ECB has also followed suit. Even in China, we see the central bank doing quantitative easing to prop up the economy. Our central bank has also followed suit and hence cut rates in the recent monetary policy. They've also tried to infuse liquidity into our bond markets because essentially transmission was the problem. In spite of RBI cutting rates, the yields in the market were not coming down. So RBI has used a new tool this time to infuse liquidity. It is basically the forex swap window. They've done $5 billion and they've indicated that they'll do another $5 billion this month. We feel that if need be, they might do another $10 to $15 billion. Essentially, what the swap does is that it absorbs dollars. So RBI buys dollars in spot and promises to sell dollars back to investors after 3 years. What essentially this does is that it brings down the hedge cost for foreign investors and makes India more attractive as a destination. So liquidity has come in March. We've seen almost $5.5 billion of FI flows in equity as well as debt. On the back of this, we've also seen our equity markets rallying. It went up 7% in the month of March. The mid and small cap indices also went up quite sharply. So for the year, the financial year Nifty is done about 15%. However, the small and mid cap indices have lagged behind because the broader markets has not participated. Our view is that going into the election result season, which is expected to be towards end of May, flows will be a little muted because people will want to see how this event plays out. The earnings season is going to start for the fourth quarter and for the entire financial year. We see pockets of slowdown, especially in the consumer space, the auto space. However, one space where we are seeing a turnaround is corporate banks, which were reeling under high NPAs, and provisioning was keeping earnings very muted. Bulk of the provisioning is behind us, so we see earnings accelerate for corporate banks. Even for next year, we are seeing an earnings growth of 24% for the Nifty. Even within this, a large part of this earnings acceleration is coming from corporate banks. We do believe private capex should revive later next year because you're already hitting capacity utilization of 75-76%. However, a lot will hinge on a stable government and what kind of policies they are able to adopt to promote capital expenditure in India. Coming back to the 10-year challenge, what we did was we've analyzed investors who came in at different points in time in Indian markets, and had they stayed invested for 10 years, what is the outcomes they would have seen. So somebody who came in 2003 obviously would have seen very strong returns if he stayed invested till 2013, and we've given all three buckets of the equity market: large cap, mid cap, as well as multi caps. The investor would have generated very strong returns, closer to 23-24%, because when you came in 2003, valuations were very depressed. Then we have tried to contrast it with a couple of investors one who came in 2005, somewhere in between in terms of valuation, and someone who came in at the peak of the market in 2007. Now, the person who came in 2005 and stayed invested till 2015 still made about 17 to 19% over the 10-year period that he stayed invested. The person who came in 2007 obviously came in at a time when valuations were very expensive. However, he would have still made about 8 to 12% had he stayed invested for 10 years. What this tells us is that having said that, the journey for these investors has not been very smooth, because there have been pockets where markets has corrected even as high as 50% or 20%. So what we realized was that, you know, most investors come into the market and they come in to stay invested for longer periods of time because they want to achieve double-digit returns from equity markets. However, what a lot of us do not prepare ourselves for is the journey to get to those mid-teen double-digit returns or high double-digit returns, because getting to that number is basically filled with periods where you see big negative returns on your portfolios. So hence we thought, you know, by bringing these case studies, we'll be able to tell you the journey of an equity investor who eventually gets higher returns but has to stay through periods of volatility like the one that we've seen in the last 12 to 15 months. And one of the tools that helps you stay invested or helps you stay disciplined is the investment charter tool that we've been propagating since the beginning of this calendar year. If you've not done an investment charter for yourself or for your family, I suggest you get in touch with one of our financial advisors and they'll be happy to design one for you. Fixed income investors, I think it's the time to keep it simple. If you see AAA bond funds, they're still giving you a net yield of closer to 7.4, 7.5. And this is the yield that you'll get if you stay invested for 2 to 3 years. There is a large opportunity opening up in the AA space because this part of the market has been ignored after the IL&FS crisis, and it is giving a yield of almost as high as 8.5 to 9% in certain cases. So this is a space that we are studying very, very closely, and we will come back to you with an update pretty soon. But I feel that AA part of the market is getting to be very, very attractive because the difference between AAA and AA is very, very wide, and there are some very good quality issuers who are giving very, very attractive rates of interest. So if you contrast it with where inflation is today, closer to 2.5, 3%, the real yields are very, very high. So fixed income investors have never had it so good, and we believe that you should keep it simple and stay invested in funds which have maturities between 2 to 3 years, AAA, and selectively start looking at AA funds as well. Thank you very much.